good evening, everyone. Thank you for joining us on this glorious evening. If you don't like football, we have a very alternative, wonderful program to go through today and talk about a very active housing market and what that means, particularly for buy-to-let. Some stats will be unmasked as myths. Some novel approaches to the market will be unveiled. And if you do like football, congratulations, because 2-0 is an amazing result. I come from the Netherlands, and we were kicked out without any glory on Saturday. So I'm going to switch allegiance to England and say I always thought we would win. So fantastic, and without even any penalties. So we're going to continue that successful run of the beginning of the evening in this session. We're not doing this alone. So we have two esteemed speakers with us. So welcome Kate Faulkner, our resident property expert, who thinks and talks about property, house prices, and how we can make the market better deeply, and is willing to share that today, as he does often. And then Russell, welcome very much. Thanks for joining from Vesta Property, a new way to make some inefficiencies in the market go smoother. As a fellow startup, we really appreciate. I will say a bit as well. I'm Martin. I'm the CFO at Habito, and I will say a bit more about what we're seeing in the mortgage side of the market and what we're seeing on the lending side. And throughout our chats, please ask questions in the chat. There is a button to ask questions called Q&A. And I will look at your questions and ask them to the panelists, particularly at when we've all stopped doing our intros. And then planning to stop in about an hour. That's okay? Great. Well, without further, I have beautiful pictures of the other two. And then one we had lying around for me.
I think mine was taken a few years ago. I'm a bit more grey than that now.
Let's share that even more wisdom, Kate. So
You're very kind.
It's been a very weird year. We were just saying to each other before in the housing market. So trying to make sense of it is even harder than usual. Kate, do you want to have a go?
Yeah, I'll give that a go. That's kind of what I like doing. So let's first chat about the economy, so we can jump on to the slide with a table. That would be marvelous. Right, so this is kind of stuff that I enjoy looking at. I have to say, so looking at different data, I try and use the data as consistently as possible. So normally I'd put up OBR, which is the Office of Budget Responsibility data, but they haven't released theirs yet. So they're still looking at March. However, the closest that I could find, which seemed to have similar figures to presenting last time, for those of you here, thank you for coming again. KPMG have done quite a good report. So you can see down the right-hand side, I've given a link to that report, which I think this is pretty. I found this pretty useful to get my head around what's happening. And as we know, 2020 economically was a complete disaster, and as was consumer spending and investment. But interestingly, when you look now at the expectations for 2021 and indeed 2022, basically what it says is, look, actually, we're all sitting on a lot more cash than we expected to be. And certainly thinking about how we've opened the property market, and everybody kind of went nuts, looking at how people have gone back into pubs and restaurants, for example, when able, gone on staycations, or indeed for those that are extraordinarily brave, I think personally, headed abroad. You can see that the figures for 2021 and for 2022 are pretty good, so much so that activity is looking, they're expecting activity in the economy to return to pre-COVID levels by the first quarter of 2022, which would be astonishing. We've had so many forecasts before over the last 12 months, and they were really looking at 25, 26 before we were going to recover. So I have to say this is all looking very, very good news. The employment rate at one point was expected to possibly go 10, 15, 10, 14%. And you can see now that that's looking, it's obviously not nice if anybody's going to be made unemployed, but the rates aren't going up or expected to reach anything like we expected. And inflation probably, and particularly in property, if you think about property itself, obviously we've seen prices go up. We have seen rents go up. We'll look at that a little minute. But also the big thing that I'm picking up from property people is the huge cost of increasing materials. So I was reading a Facebook post today of a self-builder. They have just spent £70,000 today getting all their materials in, because if they waited till next week, it would cost them well in excess of £100,000. So there's some, big increases on their way there. So although inflation in general isn't looking too bad, I think on the property side, we're in our own little bubble on that. So do beware. But the good news, actually, certainly for buy-to-let investors, is that if that base interest rate stays that low, then it's likely that your mortgages will do so too. But I'll leave that to Martin to talk about. So the interesting thing is they also do a regional, on the next slide, they do a regional recovery and show you the kind of difference that we're expecting. So I'll leave you to have a little look through this at your leisure, because obviously you're very welcome to these slides. It's also quite useful, and I'm going to map out, I think, how house prices have gone up versus these different falls in 2020 and rises in 2021, because that'll be an interesting analysis. But it looks like West Midlands and London are going to recover most. You'd kind of expect West Midlands to be up there, because actually it had the worst year last year, bear in mind. So it's not a surprise that that's looking to be the best recovery. But, we do know that the economy is very closely linked to property success, particularly in the rental market when we come onto the wages. And we're looking at East of England and West Midlands being the winners, if you like, for growth this year and beyond. So that's looking, it's really good. And you can kind of see that there is quite a big difference when you look at sort of 6% growth, hardly any growth in Northern Ireland next year. It looks like they're struggling that little bit, right up to sort of 9.5% in West Midlands. So it's something to consider anyway in terms of your investment and what's happening to your portfolio depending on where it is. So moving on to wages next. I love the most important thing about wages is that it's not necessarily that it influences house prices so much. It does to some extent. It's come back more. It's a stronger cap, if you like, on property prices, and it's why East Anglia, London and the South West hasn't grown over the last 12 months as much, because now there is a cap on mortgage lending, if you like, with 4.5 times, which you can lend 4.5 times income, and people being assessed at 6-7% interest rates. Those three areas have very much had their house price growth sort of capped, if you like, whereas all the other areas where you're seeing bigger increases, the reason for that is because they've got there's more better affordability, so the prices can grow, they've got room to grow, versus the new mortgage rules that came in 2014. So some pretty good average pay growth rate. It's not a surprise. And what I would do, we'll talk about this a little bit, but do remember, do take with a bit of a pinch of salt year-on-year data, because obviously we're comparing this year to a really odd year last year. So there's lots of talk about house price crashes and all sorts of things today, but I'm certainly not a great football forecaster, as I found, but I'm pleased to see that England did well, but slightly better on property. And you'll see that I'm not expecting things to crash anytime soon. And one of the reasons, though, which is really good for anybody in the property market, is because they can pay more for a house or they can pay more for rent, is that the fall in the number of proportionally lower paid jobs has fallen. So whether that pay rise as the economy opens up even more will continue year on year, we don't quite know. And the unemployment rate actually fell, which we weren't expecting. So that is continued good news. And the biggest sort of thing that connects to is really the wage side, is what's happening to rents. And on the next slide, you can have a little look. We use the Office of National Statistics. It's a fantastic index. The only difficulty with it is it only looks at regional, which isn't really detailed enough for you as a would-be or current investors. But it's kind of a useful gauge. You know how much your rent's going up by, and you can assess them against. So if you're in the northeast and your rents have not gone up by just under 1.5%, you might want to think why that hasn't happened. But I'm pleased to see that my local neighbourhood, the East Midlands, is top of the charts. That vast evil increase that all the landlords are putting through here is just under 2.5%. And to about on average over the last 10 years, rents have gone up by about 2% each year. On a national basis. So they're doing very well, as is the Southwest and the West Midlands. And everywhere else is actually, not too bad. It's pretty much sort of inflation rate rises, and certainly not the kind of skyrocketing rubbish that everybody trips out when it talks through. So from a rental perspective, we are seeing things very good, and it's almost been overshadowed, the rental market, by what's been happening to house prices. But we've had a very robust rental market over the last 12 months. It has survived a pandemic extraordinarily well. Of course, some people are having a tough time because of the eviction issues, and we'll see that'll kind of unravel itself over the next kind of 6 months, particularly in England, because in Wales and Scotland, people have been able to access loans, whereas the government here has decided that landlords can cough up the money. So the next question is, are we going from property boom to bust? I kind of already answered that. And if we jump a couple of slides onto the next table, what you can see here, I just think this is a really useful set of data. So I'm not going to apologize for presenting this several times to you. This kind of shows you what's happened to house price growth in 5-year slots back to 2000. And the next kind of 5 years, these were the predictions. We're looking at rates to be pretty similar, if you like, to the last 5 years, but nothing like we saw the growth rate in 2000, 2005, when kind of everybody went nuts in the property market. And that was after the kind of financial market stopped delivering at the end of the 1990s and had lots of bad press. But what you can see is this kind of goes in waves. So you get a good 5 years, poor 5 years, then you get a better 5 years, etc. So we are looking now, probably these 2 5-year periods from 2015, whereby we're seeing quite possibly long-term house price growth. And part of this is because, as I said before, wages are coming more back into affording property, because a lot of the kind of money that came in from bank and mum and dad, the buy-to-let money that came into the market, and this was all 2000, 2005 that drove those figures, and people inheriting property, that I think that's probably washed through the system. So these are, there's a range of forecasts there, but there'll always be some properties that do well and some properties that don't do so well. So that we're not expecting, nobody's putting these out to change anymore. The newest one that's come out that I rate are the PwC growth rates on the next slide. And these are pretty much in line with what may be a little bit more buoyant. They've got 2 forecasts. One is for a quick recovery, so pretty much what KPMG put up that I did later, and they're suggesting that you have a 7% increase this year, a 4% increase this year, and the following years perhaps higher than everybody else, about 4 to 5%. We're probably seeing 3 to 4% growth for most people forecasting for up to 2025. However, if for any reason it comes to September and everybody decides to batten down the hatches because we're all scared of going out again for understandable reasons, we could be expecting quite a lot lower growth. So there's quite a big difference there, really, certainly for the next couple of years. But at the end of the day, it's all positive. And let's face it, there's lots of markets that haven't been blessed with what's happened to ours. So the next slide that I've done after this one is the way I was trying to explain the way that I kind of forecast what I expect to happen to prices in the short term. And on the next slide, you'll see that what I've done is I've taken nationwide and Halifax house price growth, because these are probably the 2 that are featured the most. And Rightmove's the other one that's featured. So what you can see here is that in January 2021, the average house price, according to Nationwide, was just under £230,000. And that was a 6% increase on the previous January, the previous year. We saw a 7% growth in February, 6 in March, 7 in April, jump up in May, And I literally just plucked some figures out the air and said, well, let's say that house prices kind of keep going for the next month or so. But then let's say they're unlikely to carry on at the growth rates that they are now. Might be completely wrong, but there's almost a point to doing the forecast in this way that I've done. I've also done with exactly the same with Halifax. And just so as you know, out of these two indices, I trust the nationwide one, but we really question the Halifax one. We haven't seen it be totally correct since 2007. It works for this case that I wanted to put forward to you. But certainly their month-on-month stuff is all over the place. So we don't worry about month-on-month data. We think we just haven't seen that that's a very robust way of measuring the market. So we ignore what they all say. So what you can see here is that Halifax did pretty much along the same lines as nationwide. And what I would say to everybody is don't worry too much. Everybody's kind of panicking about these huge price rises. And obviously, if you're an investor and you've got property now, that's fantastic. But if you are a first-time buyer or you're a first-time investor, these will look a little scary. But do remember that this time last year we weren't collecting that much data. And I'm not sure really how trustworthy this data is until kind of August, September. The other thing that happens, and I hope it kind of show you in this chart, I really want to kind of draw lines, is what basically happened last year was you had quite a kind of flat market going up into June. And then house prices started to rise as everybody came back into the market and really started to rocket towards December. So when you bring in the house prices today, you've got this quite a flat market, not rising that much. And yet you're working from December. So house prices here are higher. So you've got this huge gap between the two. But then what's going to happen is the data it's going to be assessed against is going to go up as well, because that's house prices started going up to August, September last year. So the two, I think, are going to get closer and closer. And that's why I've kind of made up the figures that I have to show you that actually we're expecting this to be a one-off uplift. It's very much driven by the lack of data from last year. We do know house prices are going up. There's no question of that. And some quite silly prices as well, but obviously good for those that are making the money out of it. But we don't expect that to continue through this year. And in fact, it may even be that some of these turn into falls. That could happen as well if house prices start slipping back and the froth, if you like, that we're seeing at the moment comes back. So I hope that, do ask me some questions about this if I haven't explained that well enough. But the best way I found to forecast the market is forecast what I think the indices are going to be saying. And I know pretty much what they're going to be saying because I know what they said last year and I know what's happening this year. And if you get that right, that will feed into the press as to what the press is saying about the market. So from August time, the Daily Mail, for example, will be telling you that house prices are crashing all over the place. And what that actually means is the growth in house prices is falling, not that the house prices are actually falling themselves, but they choose their titles very carefully. So I think that that this froth that we're seeing at the moment will dissipate towards the end of the year for the kind of, firstly, because we haven't got the big stamp duty holiday from the end of tomorrow, but secondly, because of how the house prices worked last year. The other forecast is quite interesting, is that Zoopla, who do a pretty good at what they do, they're forecasting 1.5 million transactions this year. Now, if that actually happens, that's one of 4 years that's we've pushed through that many house sales since 2000. So that's huge, but it could then towards the end of the year, and it means that demand will tend to settle it down. So if you kind of think of the property market as a sea, it'll kind of go up and down, and in the waves that happen, if you like, you get a big wave and then you get a little one. That's kind of how the market works. So I hope that's kind of useful to sort of explain what I think is going to happen and why I'm not kind of running away with myself with like lots of people are doing, going, oh my word, yeah, I suppose they're going through the roof, blah, blah, blah. And it's like, yeah, but they'll just settle down. And I'm fairly confident that will happen. But we'll wait and see. I might be completely wrong. So you can laugh at me in the next one if I've messed up. And then the other thing that I think is really, really important to raise, because I'm very nervous that people aren't putting a lot of money, enough money aside for this, is that I know I've seen some despair about the eco changes that landlords have to make, but they are coming, and you are going to have to put potentially some thousands, if not even tens of thousands, behind changes to your existing portfolio, or indeed if you're looking at buying anything, and particularly if it needs a refurb, make sure you have a serious refurb plan that meets the future expectations of what the government will want. Because if you don't, you could end up having to pay for 2 refurbishments rather than 1, and I wouldn't want you doing that. So if we go on to the next slide, it really is about getting a plan, as far as I'm concerned, and a financial plan together, because this is not going to go away. The UK has net zero targets that it has to achieve, and housing is an essential part of housing changes are essential part of achieving those. We cannot achieve those targets that have been given to the UK without getting our housing stock better. And the levers the government have got is social housing and what it can do for them, which will be very nice to and help them with lots of money, as it has done already. But I'm afraid you're next in the queue, and as always, you'll get a kick to get this done. And we know that the various grants that have come out have just been a dismal failure. So my view is do you know what? Budget for all of the changes that you need to make yourself. And if you get a government grant, or that becomes available, great, but don't bank on it. You're better off getting it done sooner rather than later. So the big change is that it is predicted that either by 2025, if the current consultation goes through and is accepted, or if the existing rules come through, it'll be 2028, that all rented homes have to be C-rated from an EPC. So at the moment, you can't rent out F and G properties with an EPC rating of F and G. The average for all properties is D. And the government need to raise that to C, and they're going to force landlords to do that because they can do so. There's, again, in the PwC report, they put quite a lot of information in there about what can be done. So I've highlighted some of the kind of 6 things that you could do. I would suggest you get a good energy efficiency expert out to give you some advice. There's been some horrendous stories about problems with cavity wall insulation, which has caused houses to be overrun with damp and mold. So certainly anything like that, it's really worth making sure that you get some expert advice for before you spend your money. And they reckon for any, if you do these 6 things for any properties that are built before 2018, your tenants could save £178 a year. And you might think, well, I don't care. That's not out of my pocket, but you should care. Because at the end of the day, that's £178 potentially that more money that they could pay for your rent. So it means you get your rent better. And secondly, certainly with potential changes that they're putting through in terms of getting mortgages and getting lenders to have more a higher energy efficiency on their lending stock, if you like, on property stock, it potentially can improve your property value. I don't believe a lot of the stats that are going out to say it'll improve values by 10, 15, 20%. It won't, but it can certainly make that difference that might just put you over, or bring your loan to value down enough. That means you could potentially save all the money on getting a better mortgage rate. And that's not such a bad thing to do. And the reason really that you kind of need to have a plan is that, if we just jump to the last slide, is that the councils are being given extra funding. It's not huge amounts, but it's enough to run around and go and find all of the F and G rated properties, EPC rated properties that are still being rented out and that don't have an exemption, and they're going to be looking at fining landlords up to £5,000 for inaction. As I mentioned, my view is, do you know what? Just do what you can. Get your property up to EPC rating of C. If you're doing a refurb, there's kind of no excuse, I don't think, not to do that. It's good for the value of your asset, and it's good for your customers, your tenants. So, and it's a good selling point as well. So that's worth doing. And the other thing to highlight, and we're not kind of quite sure how much this is going to impact, but for example, if you're building a new home from 2025, you will not be allowed to fit traditional boilers. And there's lots of discussion on this at the moment. So I've had a little look. It doesn't So you won't as a landlord, unless the government decide that they want you to and insist that you stop. All landlords can't have boilers from 2030. And I'm not saying that's definitely not what they're saying at this stage, but it could be what they do. What the rule is at the moment is that if you have, they can't stop you from putting in a new boiler now or in the next 5 years, etc. But it will mean that from the middle of sort of the mid 2030s, and that's not actually that long away from a heating system timeline perspective, that it's unlikely you will be able to continue with boiler systems, the traditional boiler systems that you're used to. So this is going to be a key part of being a landlord, is understanding energy efficiency and providing the right property. So you've really got to get your heads around this, understand it, and it's not something I particularly want to be an expert on, if I like. So find somebody who is, because they could potentially be worth their sort of weight in gold. This could be, we're talking thousands, if not tens of thousands of pounds, if you know, and if you haven't planned for that, that could sort of make or break your investment. So hope that was a good update really on everything that's happening, and look forward to your questions later.
Kate, can I ask one question?
Yeah, sure.
Because maybe a quick one question from Leonard. What drives the timeline, and whether it's 25 or 28? Is that the COP conference this autumn, or when?
So we basically at this moment in time, in law, it's 2028 that you have to have an EPC rating of C. But there is a new consultation that came out at the end of December to bring that forward to 2025. And we are waiting at this moment in time to find out if they're going to change the 2028 date, or if they're going to move it forward to 2025. So we actually don't know the answer yet. My view is you're going to have to do it. And if you're certainly doing a refurb between now and 2025, just get it done. And make the changes, because it's so much cheaper to make the changes than having to do a refurb now and then do a refurb in, you know, whether it's 24 or 27, if you like, to meet the targets.
Yeah. Okay. I think that makes sense. Thank you very much. So we'll keep more questions until later. Please keep asking them in the Q&A function of at the top or bottom of your screen, depending on how you look. So thank you, Kate. That was very interesting. So over to Russell. Russell from is the CEO and founder of Vesta Property. Thank you for joining us. Also, you want to explain, I think you're first going to explain the problem you're solving. Maybe that's a good way to talk about Vesta as well.
Absolutely. Thank you very much for the opportunity. If you jump straight into the next slide, basically Vesta was set up to solve for this problem. If you're looking to sell a rental property on the high street, 99% of agents are focused on the owner-occupier market. So the first thing they'll ask you to do is look to remove your tenants before they start marketing it. It's not always the case, but it's the majority of the cases. And the reason for that is very simply, it's much easier to sell a property to an owner-occupier if there aren't tenants in there. As soon as there are tenants in there, you have all sorts of you need to get their permission, you need to give them advance notice, etc., etc. So it's much easier for the agent to sell without tenants. Now, if you add up what that costs landlords over the period that the property is vacant from the time you start marketing it to when you actually complete on the sale, we worked it out pre-COVID at over £500 million a year in lost rental income. Post-COVID, I suspect that is probably twice that, given it's taking twice as long for properties to complete now. And the other issue is you unnecessarily displace and inconvenience tenants. What tends to happen is often a landlord will sell a property, another landlord will buy it, it'll be vacant, they'll refurbish it, and then they'll rent it out again. So why not buy it with the tenants in place? If you jump to the next slide, just to highlight how big this problem is, and 20% of roughly 20% of all residential transactions in the UK are for investment property. So it is very significant. Now, this data is a little bit old. We've not done an update because I don't think the last 12 months worth of data is very robust. and the stuff that we've seen just doesn't make any sense. So I've not added that in, but in time we will. I think if you go back far enough, you can see the trend is very, it's around 20% all the way through. So it is a significant chunk of the property market in the UK today. And if we jump onto the next one, just to kind of show the scale of the market. Now, back in 2016, the rental market was worth 1.4 trillion and 5.7 million homes, and that was 20% of all homes. It's predicted by PwC and Savills by 2025 to be 1.7 trillion, 7.2 million homes, and 25% of all homes in the UK. Now, with what's happened with COVID, I think that's going to go up even higher, simply because people will be either renting in the city when they're there from a flexible working perspective, and then living elsewhere, or vice versa, depending on the type of role people are doing. But whatever you look at, it is growing, and growing at a significant rate. And then one of the other reasons, if we pop onto the next slide, that Vesta was founded, and why this was such a big opportunity. In the UK, only 2.5% of the PRS, the private rented sector, is owned by institutions. And in the USA, Netherlands, Germany, and many other countries, is kind of 25% plus. And effectively what's happened in the UK is there's individual landlords that'll own between 1 and 4 properties. And it's very hard for the institutions to come in and buy up that stock on a bulk basis. They tend not to do transactions that are less than 50 or 100 million. And it's hard for them to get access to this stock. And so what we're trying to do at Vesta is to effectively create a platform that allows access to all of that stock on a bulk basis. And the next slide just kind of highlights what we're about. In effect, we are a marketplace for buying and selling investment property. The vast majority of properties we sell are sold with tenants in place. And we work very closely with the tenants, with the managing agents, and with the landlords to make that as harmonious as possible for both seller, buyer, and of course the tenants. The other thing that we do very differently to any other platform in the market, the way I describe us is we're kind of a hybrid between a portal like a Rightmove or a Zoopla, and then an online agent like Purple Bricks. So we operate as the portal, but only for investment property. And then we operate as the agent because we need to, from a regulatory perspective, to ensure we offer the best possible service. And the one big point of difference on the next slide is every property that we present has a business case with it. It is presented as an investment opportunity. So we look at what the tenant's history looks like. We look at what tenancy agreements are in place, how long they've been in place, what the gross yield is, what the net yield is, what the annual growth might look like, etc., and provide as much information to the potential buyer as possible. And we see this as a key strength, as most of you landlords will know the local market. What we're trying to do is bring in more and more data, so that when we present a property, we present deep insight into that specific area, that specific style of property, the specific demand for that type of property, what's happening with local businesses in that area, and to allow landlords from anywhere to buy anywhere, but have the same insight that they would have if they were living around the corner. So what I thought I'd do is just provide some market insights in what we're experiencing. Kate's done a great job of kind of providing a holistic view of what's happening in the market and the economy. And I thought I'd just throw in some of the stuff that we're actually seeing on the ground. As a marketplace, we're fortunate to obviously see kind of the hands-on experienced kind of interactions. And the first slide I've popped in, which is very relevant given what Kate spoke about with growth and rental yields in the regions. This is the demand by region on the Vesta platform. So this is what landlords are looking for. And we were quite surprised when we look at this each month that it is so similar across all the different regions. There's no specific region that absolutely stands out. And so there is clearly demand for rental property in every single region, and landlords want to invest across every single region. What we have seen over the last 12 months is London has, as a percentage, is reduced. And that's simply because demand outside London is grown so significantly. And then the question we get asked a lot is, what's popular? And these are the most popular listings we've had on Vesta. And I think it highlights that there is kind of a real broad type of property that different investors are interested in. So the first one is Banbury in Oxfordshire. It's a 200k property. The gross yield is 5.1, so it's not, you know, incredibly exciting. It's above kind of the 5, which is great. And that's attracted, you know, the most attention of any listing that we've had on the platform. The next one in Blackpool, unsurprisingly, was very, very popular with a 11% yield. You know, most landlords would kind of bite your hand off for that. And then the third one was a one-bed apartment in Crouch End. Now the yield on that at 6.6 was very attractive, but there was great demand on this also from an owner-occupier perspective, which made it very, very popular. Then the next slide. So one of the things that we try and do is, because a lot of our landlords live all over the country and all over the world for that matter, is do virtual viewings. And only once we have a very serious buyer who's put an offer in, will we arrange a viewing. That's not always the case, but you know, in most instances, that's the way we will operate. This specific property had the most viewings out of any property on site, and the demand for this property was simply so high that we had a couple of open days and had over 20 odd people at each, basically to go through the property. And this was during COVID time, so you know, we had to follow all the rules and disinfect in between, so it was a bit of a crazy sale. And then the next slide is just looking at you know, what we accommodate for. You know, we have every style of investment property you can think of, whether it's a single unit, like for example this £46,500 property, which is actually a terraced house. We have apartments, we have blocks, we have student accommodation, we have entire portfolios. You can see the middle property was bought by a well-known university for student accommodation. It's very near Addenbrooke's Hospital, so it was perfectly located for them. And then on the institutional side, we had quite a nice big chunky transaction there. That's our biggest completed transaction, but we have some much bigger ones in the pipeline right now. And what we've started to do, which I think is really interesting for landlords that are thinking of selling, is when you have institutions, they want to buy 100 million, 200 million pound blocks. They're not really interested in buying, you know, one or two properties and then adding them all together. So what we've started doing is building aggregated portfolios where we will pull together 100 million pound portfolio from multiple vendors. We'll sign them all up to the same solicitor who will manage the transaction. And from the institution perspective, it looks like they are doing a single transaction, but there are, you know, literally hundreds of vendors selling into that institution simultaneously on the same day. Yep.
So I got a clarification question about. I think in general, the beautiful stats you have, people should make for any investment they do, and it's handy that you do them for them. Question is what the initial investment is. My guess is this is assuming a 75% mortgage. So it's your deposit plus transaction cost.
It depends. So for each buyer, we will create a bespoke business case. So once we know you're a serious buyer and you're looking at proceeding, we will put a bespoke business case together for you. But typically with buy-to-let mortgages, we'll be looking at a 25% deposit.
Yeah.
It does vary from time to time, and we adjust it depending on what we're seeing going on in the market. The difficulty we have is the way this system is created, we need a generic version across all properties. But as soon as you're interested in a property and you know what you're looking to do, you can take you let us know and we can provide a bespoke business case for you for a specific property.
Great, thank you.
We hope to automate it in due course, but we're still quite new. And just from a trends perspective, some of the things that we've seen more recently. So we've seen quite a significant increase in vendors looking to sell one-bedroom apartments in the larger cities. That's absolutely driven by COVID. And interestingly enough, we've started to see demand for one-bedroom start to creep up again. And I think that's the result of flexible working arrangements where people are looking to have a city-based pad for 1 or 2 nights a week. We are seeing a lot of growth in demand from first-time buyer landlords. This is, for example, somebody who's living in London, can't afford to get onto the property ladder in London, but can afford to buy a buy-to-let further north and at least get onto the property ladder. We're seeing a lot more money coming into residential investment from other assets, and what that means is we have a lot of buyers who are coming in with cash. Now the vast majority will buy in cash and then refinance after they've purchased the property. But we've seen in some big chunky cash buyers, we've got a couple of buyers at the moment who have 200 million pounds worth of cash. They're looking to purchase specific styles of property and then refinance, as an example. And the big thing for us, and this has all happened through the kind of the COVID period, is there is massive and growing demand for rental stock, existing rental stock from institutions, family offices, high net worths, and social providers. And this is simply because the returns that they're getting, obviously not for social, but the returns that they're getting and the safety of bricks and mortar pretty much outweighs almost everything else other than Bitcoin. But there's obviously a lot of risk associated to that. So we're seeing a lot of people move into this space and build up quite significant chunky portfolios in residential. And we see that as a huge opportunity. So hopefully that provides a flavor of what we're doing and what we're about. And we're talking about house prices and what might happen. My view, and obviously I would say this, is if you're a landlord thinking about selling, there's never been a better time to sell right now. You can keep your tenants in place if you use somebody like Vesta, and B, there is a shortage of stock, so you can get pretty good prices. Not always, because it depends on the property, depends on the location, depends on the tenant arrangements that you have. But we're seeing very good prices achieved for the good quality properties that we have.
Great, that's very helpful. Yeah, I think in general, whether you want to sell or buy, just having more liquidity in the market makes it easier to treat buy-to-let as a normal investment, and makes it easier to get a share or all of it away. If you want to recycle, do something else, leverage up. If doing up properties is your thing, knowing that there is a platform to sell off to makes sense. Great, thank you. So let me say a few things about what we're seeing in the on the market. So when I say the market, you hopefully know Habito. Otherwise, what are you doing here? But we are the leading digital broker in mortgages in the UK, and we're also a lender. And we're lending where we feel products should exist that don't exist yet, and that includes the first long-term fixed in the residential market and also buy-to-let mortgages. So what we're seeing in both brokerage and lending is the following. There is a lot of overhang of the stamp duty. You may hear something about it. You may know all about this, but let me just reiterate what's going on. The stamp duty was exempted for the first 500k when in the midst of the first lockdown, and then in the 4th of March, we all thought that Rishi Sunak would announce that it was over on the 31st of March, as we thought it would be, and he announced something else. So exhausted surveyors that had been working to get as many through as possible were the opposite of delighted, but the housing market overall was very happy. And what was agreed was a tapering, and the effect goes away slowly. One is tomorrow. Tomorrow is the last day when a transaction completes. Fully the end of the mortgage and the home buying process. That for the first 500k, you pay no stamp duty tax if you're a residential buyer. If it's an additional property, as all landlords are, you have the additional 3%. So you see that if you had a £300,000 mortgage, there'll be £9,000 stamp duty tomorrow. Then there's 3 months up to my birthday, the 30th of September, where that effect goes away in the band of 250 to 500. So you still get that very low rate for the early £250,000, but it's as expensive as it was before, up to 500 in the 250 to 500,000 pounds. That means that same 300,000 mortgage is 11,500. So crucial point: stamp duty doesn't the exemption doesn't stop after tomorrow, but it gets weaker, and there's still a benefit. And then after my birthday, on the 1st of October, it goes back to what it was. And you start paying 5% again from 250,000, and that means that same property is 14,000. So it's a meaningful thing. It is the stamp duty exemption. It is completely surpassed in house price growth in the meantime. And physically, surveyors are working flat out. Not all councils have all their staff back. So it is incredibly hard to impossible to start a journey now and still get it done before the 30th of September. That is, if you're starting a journey altogether. We are seeing quite a few customers who have set up a landlord portfolio in their individual name, rather than through a limited company. There are some, for many, there are some tax advantages of having it in a limited, but when you convert, you need to pay stamp duty. That can be quicker. So that is still worth, if you're thinking of doing it anyway, trying to do that before the 30th of September is over. The bulk of the huge volumes going to the market right now is driven by a positive mix of a number of factors, and stamp duty is one of them. The second that we're seeing is because we're seeing a lot of volume in purchase completions. I thought I'd go back a few years. So this is the number of completions on house purchases, first-time buyers and home movers together, and residential and buy-to-let together. So it's the whole market, and but not refinance. And you see that the last few years, I get very worked up about it. Kate gets very worked up about it. We'll probably all three of us have great theories for the difference between years. But on the scope of things, every year is about the same size. This year is massively bigger. I've never seen anything like it. I've been in mortgages 15 years. So there is a big bulk going through it. And there's capacity constraints as a result. So the surveyors I talked about, but also the conveyancers, everyone is creaking at the seams. Some of that will return to some normality after tomorrow. A bit of an overhang, everyone will make a cup of tea, and then it will get a little bit better, a little bit lower. And that means that price discovery will be easier in some other segments as well. And I'll say a bit more about that later. That's very temporal, and there's a few COVID things that are very temporal. But I think structural changes, I think Russell, you talked about this as well. I think the appreciation of home ownership or as an important thing, that maybe you want to spend more of your budget on them before, I can see that that would not completely fall down back to the level. There's definitely the move to the country and never going to the office again, I think is over-indexing in the profession of journalists versus the general population. So that may be exaggerated, but there's a bit going on. There are more. There's more moves out of big cities, particularly London. But in general, just appreciating your home and looking to improve your home if you're not happy, I think is a structural change that will not go back to what it was before. As is being comfortable with doing things digitally, whether it's visiting Vesta or using Purplebricks rather than your local estate agent. I think in all categories, and home finance is no difference, the comfort with digital has improved, and I don't see that returning, which is clearly great for the Habito business model, but it was a trend that was going on for a long time that accelerated. And the final thing is we have an enormous amount of savings as a country. There's some talk about how skewed that is in who has it and who doesn't have it, which is bigger societal problems. But it's pretty broad and it's very large. And I think that is a one-off effect of getting to save money as you have fewer commuting costs and other things last year because there's nothing to spend it on. But also I think an appreciation of savings as well. So I can see some deposit, and I think particularly in buy-to-let, you see that the effect of higher LTV, which is there, is a little bit less pronounced than it was in Resi, where people are piling back in. What we're seeing is a bit of a different story in house prices by type of property, and detached, unsurprisingly, is taking the star role and has gone up. And that I think you showed a couple of examples on the pretty pictures just now. But interesting, after some very exciting wobbles last year when we all thought flats were dead forever, all four main property types have risen in the last few months, and flats less than others, but there's been an increase in terraced, flats, semi-detached, and fully detached properties. So there has been support for all types, as people also lose a bit of uncertainty about property. Just going on to mortgages, we are the purple pinkish lines are residential mortgages and the blue lines are buy-to-let for mortgages. And we see that all across the board, not a huge amount of change in Jan to June in buy-to-let, where in residential there's been a few very stunty prices, particularly at the lower end of LTV for properties. You don't see that as much in buy-to-let. What's also interesting is what I call the certainty premium shrinking. So if you take the fixed blue line, that's the price of a 2-year fixed, and the dotted line is the price of a 5-year fixed. And you see that that was 34 basis points in January, and that has shrunk all the way to 16 basis points now. That's a trend that's been going on for a bit. And that fits with what we're hearing from our customers. So there's more people switching to 5-year fixed. And it's a weird pricing point because I think interest rates are going to rise. The Bank of England decided otherwise last week. But it looks suddenly that the move towards negative interest rates that we were worried about even last time we had this meeting is off the table. So interest rates are either going to stay flat or more likely go up. So you'd expect that the longer end, where that is likely to happen and where the Bank of England is worried about it, would price up. So you're seeing that customers are taking advantage of this and are appreciating the certainty of a long-term fixed rate, in this case 5-year, before the market is forcing lenders to price it up. So this is probably going to look different in a month's time, I would think, or two months' time. But for now, it looks like you can get cheap protection if you don't want to move in the next 2 years or hold the property. So, like I was saying, good time to act when you're buying or selling. So we are saying, I just talked about rising inflation and maybe the mispricing of the 5-year fixed. The stamp duty tapering is too late to get onto if you are starting your journey now. Just do it because you think it's the right investment, not for the stamp duty. But if you think you can convert it to a limited, it may still be possible. Get a good lawyer. The rents have passed, I think, the low point in Jan and Feb, and it looks like they've been stronger since, which chimes with a sort of return in rental in the inner cities that Kate signaled 3 months ago. I think data supports that is ongoing, that after the low point, particularly the young have gone back to city centres, which may explain why the flats have gone up. So look for the right flat. Don't discount the whole category, would be my view. And there has been a welcome return of 80% mortgages. There were very few mortgages that had allowed a deposit of less than 25%. And there's been a return of 80% for some lenders since. And you can use that to upgrade your property to be energy efficient or to increase your leverage and maybe get 5 properties where you were only planning on having 4, if that makes sense. And as a broker, keen to say this, always look whether you're better off remortgaging. Of course, I have some views on where you could do that. There's one broker that is free, it's easy online and is available. And the products may have a £500 cashback that's still going on completion. But generally, look at the whole market. It's a big investment. It's an important one, and make sure you do your research. So with that, I'll stop talking and we'll take a few questions, conscious of time. Just one is a clarification question you got, Kate, on boilers. I know this happened in the Netherlands 2 years ago. Some amounts of shock from a few question askers around the end of traditional boilers. Can you clarify what you mean by traditional boilers?
Yes, so I believe the definition, and I do stress I'm not an expert on this, that I saw was gas and oil. So that's classed as a traditional boiler, and goodness knows what people have invented by 2025 if they're being phased out, if that makes sense. So it's your typical gas and oil, because those are the ones that cause us carbon problems.
So yeah, it's worth. So clearly, law is still shifting on this, but
yeah, and the heat pumps. So people are
news,
mentioning
right?
heat pumps and things like that. So this is an area I think where you need to go and do your own research for your sort of property and get somebody good local advice. And that could be, for example, from a surveyor who's qualified. Not just to look at the condition of your property, but quite a few of them are actually upgraded their knowledge to energy efficiency as well. So if you can get somebody that does both, that's a pretty good thing.
Yeah, but have a look at this, because it is as pretty monumental. So it's not a more efficient boiler of the type you have today. It's really new technologies as a heat pump, or well, all technologies. The central heating for a whole borough that we had in the 70s can come back, or collectors on the roof. This is, you can't just buy the boiler you had with more efficiency. So this is a big change that is.
And it's also, I think, in I don't want to kind of stray into this because I knew I'd get tongue-tied, but because there's also more that they're going to do on the mortgage side, isn't there, with regards to making sure you're lending, if I've understood it correctly, in on your lending book it has a certain energy efficiency. Is that right? Or is that what's the consultation that's come out?
That's a consultation, I think.
Okay. Yeah.
We're saying a lender should have a average rating of C, I think. But that's the same consultation when they also say maybe don't give any loans to anyone who is not C or better. So I think it's on that same spectrum.
Mm.
Yeah.
Yeah. Yeah.
So I think there's going to be a lot of activity. That also means prices will fall, which gives a bit of a dilemma. But I think I think you roughly had them in the order of impact. And I was surprised to learn that for a typical home, and please do get advice, that the energy efficiency is insulating your walls is actually, it's not a sexy thing we talk about a lot.
No.
We talk about solar panels a lot more, but it's the biggest thing you can do. And yeah, if you're doing some work to your inner outer wall anyway, that is a smart thing to do.
Definitely.
Russell, there's also a question. I think you can go straight to sales, but maybe we can make it a bit more general, which is how much does it cost to sell via Vesta?
So,
But do you see more and more retail investors discovering, like, is it have you reached parity or even cheaper than selling via other channels?
you're talking about the house price, the purchase price. There is no difference if you buy a rental property. Sorry, if you sell a rental property, you're going to get more or less the same price if you sell it owner occupier or with a tenant in place. Where it does get a bit trickier is when it's significant portfolios or significant blocks. Some of the big institutions are still looking for slight discounts, but again, the price ain't going to be hugely different. I saw there was a question around fees, and we don't charge buyers. We only sell vendors, and it's a success-based fee, like any other agent. And for bigger deals, we will negotiate, but typically it's 1.2% for exclusivity and 1.5% if it's a multi-agent agreement. But for bigger portfolios, we will negotiate because we have such demand for them that we know we'll sell them.
Makes sense. Cool. Hey, I'm conscious of time. Should we do one more question and make it a really tricky one, and then let everyone pop the champagne or beer and sing Three Lions at home? So I don't think we can do a full tutorial on the cladding problem, but I guess a question for Kate. So the question of cladding is a big problem for the UK, of course. Last time we talked a little bit about how that many lenders are very nervous about getting anyone who may need a EWS 1 certificate, which is a survey saying the cladding is fine. Short, if I take a shortcut there. Even when and there weren't that many people who could do that survey specifically for EWS. Have you had any updates? Are you hearing any white smoke coming from Bez?
No, I haven't, to be honest. I'd need to go probably just sort of hold my hand up. I probably need to relook at this. We have actually got quite a lot of information. We did about 4 articles, I think, on the cladding issue and the EWS1 forms. So if you go onto property checklists, you can find those. And if you can't for any reason, just email in and I'll send you back a link. I think, if I'm really honest, from my perspective, I don't know how long it's going to take the government to realise this is not going to go away, and that if people stuck in this situation had bought pretty much anything else, be it a car or whatever it might be, although I don't actually like sort of things like that being related to housing because it is a different market. In this particular case, this just has to be sorted. We cannot have people paying the prices they have for these properties. And in actual fact, and lenders sort of lending on these properties, with best of faith that the system had looked after everybody. I don't know how long it is going to take the government to realise this is a problem that they are going to have to sort more than they have currently. But they are going to, I fundamentally believe that they're going to have to sort this. My personal view is I think they've really just got to sit everybody around a table that ever made any money out of these properties and basically say this is going to be the bill. How are you guys going to pay for it? And I think the government should pick up a fair whack of it, you know, I don't know, with the 2/5 or whatever it might be, because the amount of money that the government will get back from doing the work that the renovation work that requires to get these properties safe is going to be enormous, and the government will actually, I think, get the tax back. So that was kind of completely back of packet calculations in my head, but it will, in terms of the jobs that would be created, that we need, all of those kind of things. So what I would say as encouragement is there are some very, very good people who are working very, very hard to represent these leaseholders in this situation, and I'm quite confident that this will get sorted. I'm just so sorry for the amount of time that it's taken. I really am, because this is just such an awful situation for people to be in. But it'll have to get sorted, because it's so unfair on people at this moment in time.
All right, thank you for that. Hey, I think we need to draw to a close, conscious we've gone over. I like that because I thought we had good discussion, interesting contributions. Hope everyone at home did as well. Just a bit of housekeeping. We have recorded this session, which we may have announced, but I should have told you this at the beginning as well. And we did that with the intent to share it. Give us a day to do up our makeup, but then we'll share it on our YouTube channel, so you can see it all back. And we will also share the link to this slide at the same time with that, so you can look at any of the interesting statistics and insights from Kate and Russell. So thanks for that. I struggled to make sense of the market, and I feel Kate and Russell have calmed me down a bit, but I think it's going to be much easier, because we'll have a normal, pretty well running market, I think, in 3 months' time when we meet again. As always, as an investor, take the long-term view and look through the cycle and figure out whether the investment is something you can afford, whether you think it's going to work, and whether you can look after the tenants well so they keep paying you. So pick the right property, look after it. It will be all right in the end, is my non-authorized financial advice. So thanks for joining us today, and we'll do another one in a few months' time. And thanks for joining today on this glorious England Victory Day. Good night.